So we had buy side resting here at 10 o'clock. Price left buy side here and drop lower. Then we close here. Then we'll be having a rally like this. So you see, this is not the type of price action you want to participate in because you see there's no price is not the balancing and imbalance. Price is just chopping higher, chopping higher. So there is little to no narrative to price here on the lower time frame on this 1 minute time frame. So it is a tricky price action. So and you do not want to base your analysis on the lower time frame. You want your analysis to be from the higher time frame. From the previous video top down analysis, we indicated that the lower time frames are subordinate to the higher time frame. So the higher time frames tell the narrative, the bulk of the narrative and the bulk of the story is being told on the higher time frames because these higher time frames, these are where the banks, these are where the institutions participating. Yeah. So the bulk of the volume is on the higher time frames. So you want to participate, you want to base your execution and everything on the higher time frames. You want to base your narrative on the higher time frames while you rely on the lower time frames for the execution. So let's see how price prints. Remember, we have a new week opening gap up here. So seeing if price is interested in lower prices. As smart money traders, one more thing, you do not want to be buying at a premium price. No matter how the no matter how the market seems to be at a nice spot for you to engage, you do not want to be a buyer while price is making highs. You want to, if you are to buy, you would wait for price to drop lower and give you an indication for lower prices. This is only when you can engage in that body of price action. Does that make sense? Because we buy at at a discounted price. We buy when the market is cheap and then we sell when it is expensive. So that's it. That is the whole basic of what we do as traders. So you see, as indicated earlier, the order flow here on the lower time frame, price is not filling imbalances. Price is just this is a chop higher. This order block here was expected here, but there's no imbalance here to validate this as a very high probability order block. So you see, the another block is more of a higher probability when it is coupled with an imbalance with a fair value gap because there is others when the last buys when the algorithm was pulling in buy orders. It was when price was dropping lower here. So when price was dropping lower here, there was buy orders being triggered inside of the market by the algorithm. This is not buy as in buying pressure. This is buy orders. The algorithm executing buy orders. So we have that here. So when price rises above this buy orders here, above this opening price of this down close candle, when price rallies higher, the algorithm will seek this down close candle where the last buy program was being executed. It will revisit it to continue filling in buy orders by traders like that. So that is it. So this we have this other block become a mitigation block here. So it's being inverted here as a mitigation block. So when an other block is not respected as a bearish order block, it becomes a mitigation block. So that is it. So for that reason, if we are to come to this new week opening gap, we do not want this imbalance to be filled. We would want this to act as a breakaway gap because this is seen as price being extremely bullish because we fail to fill in this fair value gap. This is narrative. So let's see what the US 100 is doing, which is the Nasdaq. So on the Nasdaq, it traded inside of this imbalance here. So after balance this imbalance here also. So this is an indication of a high resistance liquidity on signature. So when you have a high resistance liquidity on signature, you don't want to be you don't want to trade those signatures, especially as a developing trader, as a newly developing trader. It's better for you to just save your bullets and come back another day. Save your capital because the number one goal as traders is capital preservation. So I want to see this as an inverted fair value gap here. So this imbalance here should be an inverted fair value gap taking price to this low here and also this close if we are coming for this midpoint of this week here. So yeah, we have sell side. So I want price to respect this consecutive equipment of this week here and come for this sell side liquidity. Okay. See, there's little to no retracement in this body of price action. Price is just going where it wants to go. And you do not want to be participating in this kind of body of price action. You want to participate in price action that is giving you feedback, that is giving you a direct feedback and not giving you a 50-50 scenario or not retracing to your point of interest, your PDRs. So you want price to be respecting your PDRs that has been indicated by the algorithm. So would likely not come to this sell side liquidity, but you do not need price to go to your join liquidity for you to be profitable. When you have outlined if this is a high probability, if this is a low resistance liquidity on signature, you do not want you do not expect to see price come to your lows, to your join liquidity every single time for you to be profitable. So you need to understand when to be nimble in price. You need to understand when to take your portion off and go. For example, if you're trading from this immediate balance here after price then this breakaway gap here, this is a balanced price range because we have price offered buy side delivery and then sell side delivery. So this price range now is balanced. This is balanced pricing. You can still extend this imbalance here because can still explain this imbalance here because all of these up close candles, the algorithm sees all of this as one individual candle because they are all comprised of an imbalance. So this is the balanced price range. So when price made this balanced price range and then drop lower, the low of this candle here and the high of this candle or the opening of this candle, we expect price to balance. These are immediate rebalances. Like think of a fair value gap that does not have a gap like this, that does not have a gap like this. Think of it like the algorithm. Remember the paint brush analogy that was illustrated in episode 1 and episode 2. So when price creates something like this, so and we are to go next. If price starts the next candle here like this, so you have an imbalance. There's unfilled price action here. In this case, this is a liquidity void. This is like a liquidity void. But when you have this, when you have this portion of price action like this, and it is like this imbalance like this is a fair value gap. But when you have the next candle trading just at the low of the first previous candle, the algorithm sees this as price balancing this imbalance here. So the algorithm sees imbalances. What the algorithm sees mostly is just imbalances and liquidities. So when there's an imbalance left in price, the algorithm will be eager to rebalance that imbalance. Does that make sense? So that is the whole basic of how price is booked, from imbalances to liquidity pools, from liquidity pools to imbalances. That's all. Let's take this off. I hope you got the illustration. So if we are to go for this close here, this is blue here. If we are to go for this close here, I do not want to see this eye, the eye of this 1029 candle violated. If this eye of the if the eye of this candle is violated, yeah, this means the candle that balanced that imbalance. This is like the intermediate sell high because this is the candle that rebalanced this imbalance. So this is an immediate rebalance. So when an intermediate sell high is being violated, this is the algorithm telling you that your narrative is wrong, or you are in a uncharted territory because price is violating intermediate term highs and also violating intermediate term lows, which is indicative of a choppy price action. This is how you understand a choppy price action model. So if we are to come for this lows here, price should not violate this high here because this is an intermediate term high. So you have this long term high and you have this long term low. You have this intermediate term high, you have this as an intermediate term low, like that. So now this is a short term high. This rally higher, you are seeing this as a short term high. So you do not want price to violate this intermediate term high here. So let's watch how the algorithm boosts price. So you need to take read. Take read, especially sessions like this. This will help you to foresee and to predetermine bodies of price action you do not want to engage in. So I hope you got something from this video. The market structure can give you an idea on when your personal bias is wrong, and the market structure can give you an idea when your personal bias is on side. For example, when an intermediate term high has balanced an imbalance, You do not expect that intermediate term high to be violated. So when that intermediate term high has been respected, you understand that yes, you are in line with the algorithm, you are in line with order flow. That is market structure being in line with order flow. All what you're doing essentially is imputing all of this language together as and making it one. For